Hello, everyone. Welcome to the Techforce podcast show. I'm your host, Shivani, and today we're going to talk about equity finance and fintech revolution. And I would like to welcome our guest, Radhika. Hi, Radhika.
Hey, hi Shivani, and thanks to Techforce for having me over.
Yeah, how are you doing?
I'm doing good. How about you?
I'm doing great, great. So basically, let me give a brief introduction. Radhika is a co-founder of Beyond Equity, and she would like to talk about equity finance, something different than what like last few podcasts of mine have been. There, I've constantly been talking about blockchain and NFTs. So finally, we got something related to finance. So Radhika, can you tell our listeners what do you do?
Yeah, sure. And since it's your first topic of blockchain, I hope people find it still relevant, and I think you will find it still relevant. So hold on. So basically, just to give you a bit about myself, I am the co-CEO and COO at Beyond Equity. And Beyond Equity is basically disrupting equity financing, to put it, very simply.
Yeah.
Now, I have spent most of my life in finance. First I was at Barclays, so did many different roles within that. And then I was more of an external person to finance in the sense that I was consulting with banks, telcos, etc., on their fintech strategy. So fintech has been kind of my bread and butter since day one.
Right. Okay. I would like to say, know why equity financing? Like, why this is so much of your, like, why do you want to talk about it so much?
Yeah. So when it comes to equity financing, I think there are a few things that just don't work. And that is the reason why we actually thought about beyond equity in the first place. And even the name, right? Going
Yes.
beyond equity, basically.
Beyond it. Yeah.
Now, let me tell you a bit about like what my opinion about equity financing is. And in that, I will tell you first, maybe cover what is modern day equity financing, right?
Yes.
So now for this, I usually try to give an example that's like super relatable with most of the people. So
Yeah.
think about a scenario wherein you've had an idea for a car, like a racing car,
Okay.
since forever. Okay, you have this amazing idea and you know that you want to just do it, right?
Right. Yeah.
And now finally you have all the finances that you need for it. Let's say that you have money to buy all the parts, basically. Now,
Okay.
if you think about it, it's a no-brainer, right? Because you have the idea, you have the finances, you can just literally start manufacturing. And let's say you do that. This
Right.
journey right in the beginning is what is called bootstrapping. At this point, you are owning 100% of your equity and you're
Right.
putting in your own sweat capital and, of course, your money into it, right?
Right.
But let's say that tomorrow you start building and the car is fully ready.
Right.
However, soon after you realize that you need some safety features on your car. Okay. But if you think
Right.
about it, you have already spent all your money on the parts. Okay. So how do
Right.
you get, let's say, an expert in safety that will be able to help you out here? Now, this is the stage at which you would basically go to an investor and be like, I have this vision, this is all the time and money I've already put into it, this is
Right.
the outcome that has already been achieved, but I
Yeah.
just need money for just hiring this safety expert that I need. Can you give me some money? Now, the investor basically says to you, yeah, sure, I'll do that. I see your vision, but I still need some ownership of your car. And in that, like basically to be able to achieve that, the investor says that let me own the tires of your car, which is a small part at the end of the day
Right.
because the car is made of like
Yeah. Right.
much more complicated engines, etc., etc. So you
Yes.
think that what, I need the money, why not? And basically what will happen is that when I sell this car, the proceeds that come from the tire itself go to this investor, and you're like, sure, let me go ahead with it. This is called seed capital because this is the
Okay.
first time that money
Right.
has been pumped into your business, which was just your
Right.
dream to begin with.
Right. Right.
Now, let's say you went ahead, car is 100% ready. It's ready to hit the road. However, you then realize that, there is this approval testing that you need that you did not account for, that basically the government requires you to do before you can sell your car.
Yes.
But again, you don't have resources, right? Because you've spent everything either on the parts or on the export. So now you go again to the investors and are like, you know what, I need this again. Can you pump in more money? And this time, let's say that they take ownership of the car's engine, right? And this is called Series A, which is the second tranche of the capital that you need into your business to be able to basically launch it at this stage.
Right.
Now, every time that you need additional cash, you have no choice but to sell a small part of your car and your business. And this is called Series B, C, D, etc. Now, by the end of it, when you actually are ready to hit the market, you basically have had the need to pump in more and more money. And what you're left with is literally just the steering wheel. Because everything else you had to sell off to be able to pump in more money into the business. And this is literally what equity financing is. Equity financing is about giving up a part of your business each time you need capital to make it grow. Right? And if you think about it, equity financing has been fueling innovation for the longest time now. Right? It's been going on for decades that founders have been selling their shares, their equity to investors to be able to get their business to new heights. And a result of this is that generally globally, on an average, founders are literally left with 15% of their business at the time of exit. Okay, and this is, if putting it in the car's context, this is at the time that you're actually selling the car. And this is the reason why I really think rather that there is a need to innovate equity financing itself, right? And that's the place that we started thinking about Beyond Equity from. How do we come up with a solution that still gives founders the same money that they need to pump into the business, however, not at such a high cost to them?
Yes, right. Yes. That's actually very well put. Like the way you described equity finance, that was really the perfect way to put it. Right. Okay, so my question to you was sometimes what people do is you said about like we sell some parts of our business to the investors. Sometimes we tend to take debt to run our like business smoothly. Okay. So like what's the difference between debt finance and equity finance? Like how do you bifurcate those two?
Yeah. To put it very shortly, it comes down to risk and return. But I'll give you first the longer version and then I'll come back to the risk and return. So going back to the basics, right? Debt is basically about still taking the money that you need for the export, but hoping that you're basically able to pay it back at a later stage when you actually sell the car in this case.
Okay. Yeah. Okay. Got
it. But because of the fact that in this, the investor is not owning anything, right? So there's no, let's say, no collateral, no guarantee that the investor has that they will be able to make something, because ownership in itself comes with some form of promise of money, right?
Yes.
Now, in the absence of that, what you can do is you can basically go to, again, a bank or the same investors rather, and you can be like, you know what, don't own anything. I will pay you back this money. However, I'll keep paying you a small, and which is obviously called interest, to be able to just keep the debt with me and still, you know, giving you some kind of financial return out of it, instead of the upside that comes with ultimately selling the cars and the taxes in that matter. So now, when it comes to going into a bit more detail, right? Why debt versus equity is like even a question. So as I said, it comes down to risk versus return. So in equity, the investor is taking on a lot of risk in the sense that they own the tires, but like they don't know what the tires will be worth when you actually hit the market. They are betting on you and your vision, right? So as a result, what they expect is a higher return. So whenever the risk is higher, you want a higher return. However, in the case of debt, because you're legally obliged, and sometimes you're actually personally guaranteed to pay back the money that you have actually taken from the investor, they are okay with taking a lower return, and hence the interest goes lower. So it's at the end of the day a matter of, how much risk is the founder willing to take? Low risk in terms of equity, higher risk in terms of debt, and hence how much return are they willing to and also capable to pay, right? Because in this case, you couldn't have gone for debt because you did not have money to even furnish those interest payments, right? And that's the idea, and that's why you go to an equity investor. But otherwise, you can go to a debt investor as long as you think that you will be able to pay those interest payouts.
Right. Yeah, that's well put. You have already explained. Like, I was going to ask, like, what do you guys do at Beyond Equity? Like, what is the procedure, and what are the end goals? What kind of people are your clients? How do you work?
Yeah. So in order to, sorry.
Just a minute. Also, for our audience, I will be linking down the Beyond Equity link in the description, so you can go and check out and what does she do. Yeah, carry on.
Amazing. So now, in order to understand what Beyond Equity is, let me again go back to the basics. Okay, let me start from telling you how does an equity deal look from an investor's perspective, and then think about how do we go beyond it. Okay.
Yeah.
So for an investor, there are two key things that come out of an equity deal. Okay. The first is some kind of ownership, right? In this case, owning a tire. But like in a real world startup, what that means is that you take 10% of a company's, let's say, ownership. You give the company, let's say, $1 million in return for that. And with it comes some decision-making powers, some voting powers in the business. Okay. The second thing that they get is some money-making potential. And that money-making potential comes from two different things. First is capital appreciation. What does that mean? Coming back to the example, 10% of equity sold for $1 million. That's in year 0. What the investor expects is that in year 5, let's say, that 10% would be worth much more than that $1 million. And that is when they make capital appreciation. Their equity basically is appreciating in terms of value. The second thing is the promise for dividend. But as we all know, hardly happens. And dividend, as we said, just to quickly give you a brief, for those who don't know, is basically the share in net profit that is owed to the investor. So let's say the investor is owning 10%, then all the net profit that the company is making, 10% is owed in principle to that investor. But most modern day startups don't end up paying that dividend. They basically reinvest that into their own business. Now, this is, let's say, the package that the investor gets basically as a result of an equity deal. And this package leads to a certain valuation for the company. Right? What that means is that you're taking 10% for $1 million. That means that your company right now is worth 10 million.
10 million.
Right? 100% equity is worth 10 million. This is the valuation that comes out of it. Now, we thought, let's change some of the dynamics around this package that the investor is getting. First, let's remove any kind of ownership and voting rights and decision-making powers. So the investor does not own anything. However, on the money-making potential, one, let's give them an asset that appreciates much faster than equity. And two, let's actually give them some dividends. So some real-time payments that go to the investor. And I'll go into the details of it in a second, but what would happen if you think about it in such a package? The company would basically get a much better valuation. Why? Because the investor is making a lot more money, right? Hence, the investor is basically able to give a better deal to the investor, to the company. And let me tell you how we do this. And this is where our business basically comes in. So what we have done is we have invented this new method of financing, which is called shared growth financing. In this, what happens is that a company is able to sell a small percentage of their future revenues indefinitely. Now, this is exactly how equity works, in the sense that equity is sold indefinitely to an investor till the time there is an exit, for example. Same principles we apply to revenues. And we say that you sell this revenue indefinitely. Now, why? Right? Like, why are we doing this? Mainly to be able to come to that better valuation, and I'll explain to you how. So basically, you are saying that revenues represent the top line of the company, which is basically just how the company is getting in money. Revenues is shielded altogether from how the bottom line of the company is doing, which is the costs. Now, equity represents the difference between these two, which is revenue minus cost. We are saying that let's save the investor from how the company's costs are doing altogether. Let's only expose them to how the company's revenue is doing. What's going to happen as a result of that? Revenue of a company is much more valuable, right, than net profit, because it's always a bigger number. Hence, what that means is that, one, the investor is getting an asset that's basically, as I said, a much bigger money maker than equity, and is much more valuable than equity. And on top of that, because of the fact that the investor is owning a percentage of revenues, that means that you actually have to pay out those revenues to the investors, right? But as a result of that, the company is not going to be worth 10 million, because equity valuation, let's say, was 10 million. Now that the valuation that the company can get is at least 2x of that. And what that means is 20 million. So let's say that you're still raising that $1 million. In this case, you'll only end up selling 5% of revenues, mainly because of the fact that you're selling an asset that's, again, much more valuable. So basically, as a result of this, what we are saying is that we are introducing this new asset class, which we are calling revenue shares, right? Equity shares, revenue shares, which basically represent an ownership over a company's revenues indefinitely.
Right. Okay. Got it.
Makes sense?
Yeah. It's a bit tough to understand, but definitely it makes sense. So I would like to ask, why would a company go for growth financing, rather than equity financing? As you said, revenue based rather than equity. Especially taken in terms of the new startups, current day startups.
So when it comes to shared growth financing, there are two things that stand out immediately, right? So first thing is that the company does not have to give up any ownership. So the founder basically can, at exit, have literally 100% of the business. And that means that, let's say tomorrow the company is acquired, the proceeds from the acquisition go entirely to the founder, as opposed to 15% of it going to the founder, right? So that's the first and foremost, I would say, biggest value prop for a company. The second one is that you get a premium to equity, which means that you basically are able to raise at a better valuation than equity, mainly because of the fact that, again, you're selling an asset that's more valuable, hence you get a better deal and a lower cost of capital from the investor. The third thing is that we basically function as an exchange. What that means is that, you know how stock exchanges are, right? We are applying those principles, and we are building our own revenue exchange. And as a result of that, what a company basically gets is a much quicker time to funding. So usually equity financing, by the way, takes 6 to 9 months, right? And the long time that in this case, the person would have to, let's say, spend upon just finding that investor rather than building the car. And that's a real world example, in the sense that founders are generally just busy in fundraising rather than literally building out their business.
Actually building the business, yes.
So what we do is we help founders fund within, so once you're registered, we literally fund within 24 hours. And that we're able to do because we have a full-fledged data engine that does all the valuation of the company for us, instead of us having to do a much more qualitative analysis like traditional investors do.
Yeah. Okay,
now, the fourth thing rather is that because of the fact that we function as an exchange, there is an exit from this, an easy exit. What that means is that, let's say tomorrow you're not comfortable selling your revenues indefinitely, right? Your revenues grew 100% and you're like, I don't want to continue with this arrangement. What you can literally do is you can go to an exchange and buy back your revenue shares. This is very similar to how companies that have IPO'd can buy back their equity shares from an open market. We're applying those principles again, but to revenue shares. So a company can go to the open market and literally purchase their revenue shares back and get out of the arrangement altogether.
Would the prices differ in that?
For sure. For sure. So it really depends on how your growth trajectory has been, right? Because you do need to still compensate those investors that have
that's what I was going for,
but not the upside. So that is still the case, but usually equity does not have an exit at all. And that is what is basically different over here. And then finally, it's a difference from debt rather than equity, in the sense that, you know how I explained that the debt you have to repay, right? At the end of the day. Here, you don't have to repay anything. The $1 million that the company got, it's theirs. The investor basically makes money with the fact that they own the revenues. And on top of that, that they're getting those small chunks of revenues every year. So what that means is that from a company's perspective, the biggest investment that goes into them, they don't have the pressure to repay it back. And that's a big deal for companies. Yeah.
Oh, yes, that's nice. So like modern day startups, do you think that, what would you recommend? Do you deal with cryptocurrency at all? First of all, I would like to ask that.
Our startup is not a crypto startup. So no, however, crypto is also used for investments, and hence we are close to the topic because of that.
Okay, so that was my next question. Like, do modern equity financing do they deal in crypto at all or not?
See, they can and they can't. There are like both scenarios. So there are two forms of crypto financing that are, I would say, really popular. First is ICOs. I think we've all heard of them. Initial coin offering became really popular a few days ago, but for a few years ago, and then ran into some regulatory trouble, right? So basically, what happens in that is that you as a company are selling some promise, first of all, of a coin, and that coin can represent anything in the company. It can represent equity, right? So a stake in the company. Some form of utility in the product itself or the service itself of the company is offering. And that's in the form of the token that basically is issued as a result of this ICO. The second form, which became really popular because of the fact that it's regulated, and once ICOs started getting into trouble, STOs, which are basically security token offerings, right? And as the name itself suggests, the token itself is already representing the security, right? And securities are regulated. So what that means is that it's still dealing with tokens, but the token represents securities, and hence it's regulated, and hence it's a safer space to raise and also invest in from an investor's perspective.
Right, yes, fair enough. Okay, Radhika, that's like good knowledge of equity finance in 20 minutes summed up, right? So So basically, what I know about somewhat of this financing was I was just thinking of a show. Have you watched the show called Succession?
Succession. No.
Succession, yes. Yeah, it's a huge show. In that, this is the only case. They deal with it's a huge company, and the CEO is dealing with the who to give next, and there are siblings, and they have to uh,
Yeah,
so
I know about it. Yeah, maybe I saw it. Yeah, yeah,
yeah,
yeah.
in that the storyline goes on about finance. To keep the company alive, the way they are dealing with finance is something what you just represented. I was just thinking about it and it clicks to me. Uh, yeah. Okay, so I would like to end the podcast on a positive note. What would you like to share with our audience over here?
I think I'll talk to the founders out there. So,
Yes.
like the good part about everything that's happening with this space is that basically founders now have options, right?
Yes.
It's not just a matter of debt versus equity anymore. It's a
Right.
matter of debt, equity, revenue-based financing, crypto, and what we're introducing, shared growth financing, right?
Yes.
And as a result of that, what that means is that the incentives of the company and the founder are basically aligned, right?
Right.
Because the
Yeah.
founder, if they own 15% of the company at the end of the day, they are not that incentivized to be able to, propagate the growth of the company itself.
Yes.
However, if the founder is owning 100% of the business,
Yeah.
basically everything, every extra penny that they make
Mm.
in profits is for the founder, and which makes sense, right? Because that's how if you think about it, traditionally, that's how businesses have been run, right?
Yes.
Sole proprietor, owning everything, and just getting everything that's coming into the business into their own pockets. And this is basically where we are trying to go back to. We are trying to give founders the hope that you
Yeah.
can still own 100% of your business, put in all your effort into it, and get the monetary benefits that come out of it. So
Yeah.
this is just something that I would for sure suggest to all founders, which is to basically explore alternatives apart from equity and debt financing.
Yes. Right. Like basically, go for own your own vision. Right.
Yep,
That's
precisely.
yeah.
Thanks for putting it nicely.
Yeah. Okay, okay, Radhika. Thank you so much for coming on the show. It was really wonderful to talk about equity financing with you. And to my audience, I would like to say, please check out the links in the description. I'm putting for Beyond Equity, and I will be putting up other Radhika's profiles as well. Just go and check it out. Thank you so much, Radhika, for joining the show.
Thanks a lot for having me.
Yeah,
Good luck
have
with
a
the
good.
future.
Yeah, thank you.
Bye.
Bye.